Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and let's take a look at where markets are currently trading. Now, before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So for today, what we're going to do is we're going to start off at a higher level view to see where we currently sit from a seasonality perspective. And we're going to take a look at what seasonality looks like per month of the first year of a presidential cycle. And we're going to see that April looks like a fairly strong month. Then we're going to zoom into the broader markets to see where they currently sit within that context. And we're seeing a pretty mixed picture here across the major markets, major indices. So we'll take a look at which ones look a little bit more bullish, which ones look a little bit less bullish, the rotation that we're seeing within that sector. Within the markets. Then we'll take a look at sector rotation, which is interesting to see how that's starting to shape a little bit, especially with the infrastructure spending that we're expecting to see here at the end of this year, as well as just a general, I would say, template that we've kind of are starting to see again from right before the pandemic sell-off here. The markets that existed back then looks a little similar to what's starting to evolve here right now. Then we'll take a look at the economic data, which continues to improve and surprise us the upside, which is good for the equity markets right now from a strength perspective. And then we'll share with you few of our ideas from the overall data that we're currently taking a look at before we open this up for Q&A here at the very end. But the primary question that I want to help investors answer is really, can equity markets continue the bullish trend that we're starting to see emerge here? So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And what I want to share with you are my technical charts, my economic research, my statistical research that helps inform my decisions in how I position here in the broader markets. So we'll start off here with a zoomed out view here. This is research from Bank of America looking at every single presidential cycle year one, which is the first year after a president is elected, what the average S&P 500 returns look like pretty much since the Great Depression. And there are 3 months that jump out in terms of returns, and that is April, May, and July. These are the 3 months where the average returns on the S&P 500 is just around 2% or a little over 2%. And they are positive. It's not a strong signal, only about 60% of the time, both in April and May, 65% of the time in July, but the average move is significantly higher than the rest of the year. Pretty much all of the performance for the years, first year out of the gate for a president, comes in April, May, and July. So this is one that worth paying attention to. As you can see, the higher statistical months is November and December, but the average returns are much, much lower. So seasonality perspective, and remember, always take seasonality with a grain of salt here because it is relatively small sample sizes that we're looking at here. You want to take this type of data with a grain of salt, but looking at seasonality, March was generally a weak month. That's what we have seen, quite a bit of weakness in February and March, and April tends to see a significant shift in the other direction. So overall, that looks fairly bullish here for the broader markets. So now let's take a look at where this year's markets are currently trading. So we've talked about this S&P 500 failing at this February high recently in mid-March, failing to break out higher here. It did make higher lows, higher highs, and recently over the past couple of trading sessions have really accelerated here to the upside above the 399 all-time high here prior to the move from last Thursday. So things look fairly strong here for the S&P 500, but I will say that things have already gotten quite a bit extended over the past 2 trading sessions. As you can see, the daily RSI is approaching the 70 level, the weekly RSI approaching that 70 level here, looking similar to what we saw back here in January and February before the pandemic sell-off, starting to reach that kind of phase here where we're slowly grinding grinding our way higher. Whoops, this is IWM, where we're starting to grind our way higher here before that major sell-off. Now, that doesn't mean that we're going to sell off here. It just means that the markets that we're currently seeing set up here is looking similar to what we saw here prior to the pandemic, in terms of just a slow grind higher of just a few mega cap names kind of dragging the markets higher here. And we're going to take a look at the other markets to give us a sense for whether or not that is true. When we look at the NASDAQ 100 index, it did manage to break out above this 324 level that we said was a major resistance level and needed to get back above that level for us to resume that mildly bullish view here. We did manage to crack above that level here yesterday. We may see a bit of a pullback here today and then a continuation higher here back into the 338 all-time high here. So this is one that we do expect the NASDAQ 100 to resume its a bullish phase here again for the NASDAQ, which has largely been more on the mildly bearish and perhaps neutral view here on the NASDAQ 100. We've now gotten back into that category here, a little bit more upside to go. And if we can break out above that 337, 338 all-time high, that certainly puts the NASDAQ 100 back into that leadership position here that we have not seen the NASDAQ 100 provide leadership here over the past roughly month and a half. And then when we look at the small caps, which have provided leadership here since November, have really started to kind of lose a lot of that momentum here over the past month and a half, has made no progress here, similar to the NASDAQ 100 index. But as you can see here, the February 15th highs, which was around 230 or so, just shy of 230, we did manage to break back above that level once, but failed. And now it can't even get back to that 230 level here. So starting to form what looks almost like a bit like a head and shoulders here. Now, I don't expect small caps to correct lower here. Certainly don't expect small caps to break this 210 support level here and start moving lower. But this does show that small caps is losing momentum. We're starting to see a bit of rotation back into growth, out of value, out of small caps, back into mega caps. So the S&P 500 market cap weighted indices outperforming the Russell 2000, the small cap indice, that is starting to see a bit of rotation back into mega cap, back into growth. Now, when we look at the RSP, the S&P 500 equal weight S&P 500 index, also breaking out to new all-time highs, but not outperforming the S&P 500 market cap indices. So we're starting to see, again, the mega cap names, the concentration at the top is starting to outperform the broader S&P 500 names here. So again, starting to see the early seeds of what looks similar to what we saw back in January and February before the coronavirus sell-off, where we had what was a relatively concentrated part of the market moving higher while the rest of the market was starting to fall back behind here. And same thing here in EEM, emerging markets starting to lose ground here, still continuing to make lower lows and lower highs. Now, it did manage to break above that 21-day moving average, which is the first step in potentially resuming that bullish trend here, but 55, 56, and 58 are all resistance levels here to the upside. So EEM looking significantly weaker here in the global equity markets when we look at US versus emerging markets here, especially with the higher dollar, that puts additional pressures here on EEM. So our expectation is simply not as strong for emerging markets. Now, we've been talking about value versus growth for quite some time, how value has underperformed growth for multiple years. And we've been talking about this bottoming formation, which started to look like perhaps value was going to start outperforming growth. And if we zoom in here on this breakout level here, we have seen a bit of consolidation here to the side after that major breakout here. But this consolidation pattern is starting to get pressured to break here to the downside. So this is potentially a signal that this breakout here was a bit of a false signal and that we're going to see a continuation of growth outperforming value going forward. So this is one that we're just on the cusp of potentially having a rotation back from value into growth. And this is important because as we look for further upside, the question is, do we position more in those value-based sectors like IWD, like IWM, or do we focus more on high growth, high beta sectors like QQQ? And this is an important chart to help us make that decision, and certainly starts to look like that shift back into growth, back into mega cap names like QQQ is outperforming small caps like IWM and IWD. And especially when we take a look at the US 10-year yields, which has moderated here around the 170 basis point level, this puts more of a potential upside here for some of those high beta names. So as interest rates have kind of moderated a little bit over 170 basis points, we're yet to see if we still see a thrust here to the upside. My expectation is that there is still some upside here, but that is likely going to happen at a much slower pace than what we have seen here in over the past 3 months or so since the beginning of the year, when it broke above that 100 basis points and has quickly rallied to 170 basis points. We could even see a bit of a pullback here before we see a much slower grind here to the upside. A lot of the inflation expectations, a lot of the concerns around government spending in terms of the stimulus is, in my opinion, already priced into the equity markets. So, and in the fixed income markets here as well. So this upside that we continue to see here in the 10-year yield likely going to happen at a slightly slower pace. Now, when we look at sector rotation, this is really where we start to see clues of a few dominant sectors outperforming while all the other sectors are starting to lag behind here. So for a few weeks here, we've been talking about how financials and energy have been extremely weak here. They continue to be weak. They're now in the lagging category. We've also seen communications fall back into the lagging category. We've talked about how industrials and materials have continued to weaken, but industrials and materials have not weakened much here over the past week and a half here or so, after weakening over the past 2 weeks or so. But the leading sectors, utilities, staples, real estate, were in the leading category for a relatively short amount of time and have now all started to fall behind and starting to get into the weakening category here. So you have a lot of sectors that have seen strength here, that have started to slow down in terms of their leadership, have started to get into the weakening category here. Even healthcare that started to reach out here to the upside into that leading category has started to fall back behind. You really only have two sectors to talk about here: technology and consumer discretionary. Technology, as you can see, continues the stealth rotation here to the upside. We see consumer discretionary that was starting to fall behind get back into the leading category here. And you still have materials and industrials that have not weakened much and have a potential upside here to get back into the leading category. But right now, you really just have consumer discretionary and technology moving in the leading category direction. Everything else is moving in the lagging direction. So you really have all the sectors pretty much moving in this particular direction towards the lagging side, and you have technology and consumer discretionary, the only two moving into the leading category. Now, if that reminds anyone of anything, that should be what we saw in January and February, December, January, and February, right before the coronavirus sell-off, where we had two sectors leading the markets higher and all the other sectors being left behind. And not only that, not only was it just those two sectors continuing to lead the markets higher, it was just the mega cap names, the big names within those sectors that were leading those sectors higher. And that type of market rally is not particularly healthy. You don't want to see that. When you have that, those are the signs of, whatever sparks that next sell-off will likely be some kind of fast, violent sell-off, which is what we saw here during the pandemic. Now, I'm not expecting another 30-40% correction to happen, but if something does materialize, these are the things that lead to large, violent sell-offs here. Now, these are very early days. We could very well see some of these sectors start rotating back into the leading category here and start to see some healthy sector rotation, as we have seen pretty much for the last year. We've seen pretty much a healthy sector rotation, but we're starting to see a bit of a leadership here from two separate sectors that are dominating. Now, this could shift a little bit because we are in a very different world today, and we do have a potentially $2 trillion infrastructure spending plan potentially being passed at the end of this year. This does shift things quite a bit here for two additional sectors, which is materials and industrials. You have more than $500 million allocated to infrastructure and electric vehicles, $500 million to renewable energies and green energy and climate change related items, $500 million for manufacturing subsidies and R&D. This is a lot of the reshoring that we're talking about, changing the supply chains back to the U.S. or shifting the supply chains back to the U.S. $500 billion there, and then another close to $500 billion, a little more than $500 billion towards job training, elderly and disabled care, and all of this at the moment is being offset largely by an increase in tax revenue. Now, our expectation is that that is likely not going to happen fully, meaning there's going to be more expansion of the federal budget in order to pay for these things, but $2 trillion in spending is significant in terms of what it would do to stimulate the economy. And there are generally two segments of the market, in addition to technology and consumer discretionary, that would benefit from this. And it's the two sectors that yesterday made a new all-time high that we have not seen from any other sector yet. And that's materials and industrials. Materials reaching a new all-time high here, just breaking out above $100 here yesterday, getting back into that slow grind behavior that we saw from equity markets between November and February, right before the pandemic sell-off here. We see it in materials and we see it in industrials. Sorry, the previous chart was industrials. I labeled that XLB instead. That's a mistake. This is industrials and this is materials. The two charts look very similar. Both charts are the only two sectors that made a new all-time high here yesterday. So this is constructive here for both sectors here, as well as they show a little bit more leadership here in the broader market. So if we see technology, consumer discretionary, industrials, and materials lead the markets higher while the other seven sectors start to fall behind a little bit, that is still a healthy amount of rotation. But when we see technology and consumer discretionary dominate and the few names within those sectors dominate, that is the potential warning signs of an unhealthy market rally here. So very, very early days. Normally that takes months to evolve, which is what we saw here right before the pandemic sell-off here. So we're not there yet, but those are some of the early warning signs, and we need to pay attention to those things to decide, do we continue to have a very bullish view here in the broader markets, or more of a cautiously bullish view here in the broader markets. So shifting over here to the employment side, or to the economic side, this is where we continue to see surprises to the upside. And we're talking about surprises to the upside in the good places, because the equity markets have outperformed, I would say, economic numbers here for the past 4 or 5 months since the election. Markets are substantially higher. Economic numbers have not largely kept pace with that. But over the past month and a half, we've seen equity markets consolidate, almost waiting for economic numbers to catch up. And the good thing is that we're seeing that catch up. We're seeing strong economic numbers, surprises to the upside. Non-farm payroll came out on Friday when the markets were closed. A survey was 660,000 jobs. We added 916. The ADP private payrolls on Thursday was not as strong. The expected was 550,000 jobs. The actual number came out was 517,000. So a little lower than expected on the private payrolls, but non-farm payrolls came in significantly higher. But the important part to pay attention to here is not necessarily the number of jobs added, because there was a lot of seasonality factored into that, but it's what type of jobs were added. So out of the 517,000 jobs that were added, 437,000 came from the services side. We know that manufacturing and industrial side have employment gains have been fairly strong over the past year. They've continued to be strong here, but services is really the segment of the market that has lagged behind. But we're starting to see a significant uptick from the services employment, especially from leisure and hospitality, one of the biggest gains here. And that is constructive here for the economic recovery, especially from an employment perspective. We really wanted to see the services side come from see some strength on the employment side. We're starting to see that. That provides the evidence for the equity markets to validate where they've been trading for the past few months, and now look even further, looking outward towards the second half of the year and even into the beginning of 2022 as to what that economic recovery is going to continue to look like. So when we look at that on balance, things look fairly strong here, especially when we're about to enter earnings season. That'll provide us further evidence of the economic recovery, especially if corporate profits continue to grow to the upside in terms of revenue expectations and earnings expectations. That is the catalyst that equity markets need to continue moving higher here. And especially on the services side, ISM, this is the first time we've really seen a major surprise here to the upside in quite some time. The survey was 59, actual came in was 63.7. Significant surprise here to the upside on services PMI. And as we look at the travel planning for hotels, for theme parks, for airlines, continue to uptick, continue to see some strength here to the upside. Hotels and accommodation actually accelerating here to the upside. So this is really one that we continue to see rebound on the services side, on the travel and leisure side. That is constructive here for the equity rally that we're seeing. So when we look at the opportunities here in the markets, this is really where we want to be a little bit we want to look at some of the things that have not performed as well, actually, to look for some opportunities here as well. So when we look at Amazon, this is a stock that has largely been unloved and unfavored for quite some time, because Amazon reached about $3,200 back here in July of last year. So we're talking about over 6 months where the stock has made zero progress, while the equity markets are significantly higher than where they were in early July. So when we look at the markets here, Amazon, after trading in a range here for the past roughly 8 months or so, starting to see a little bit of relative strength here from Amazon here over the past few trading periods, starting to break out above that 21-day moving average, which has spent most of that time below that level here for the past month and a half, started to accelerate here to the upside, and I think has the potential to reach that $3,500 target here to the upside and potentially break out here for the long run, especially if we look at consumer discretionary to outperform here. Amazon is certainly one of those stocks that you want to pay attention to. Has been a large underperformer here and potentially has the opportunity to play a little bit of catch up here. When we look at the airlines, we've been talking about Southwest Airlines, we've been talking about Delta Airlines predominantly as the two main drivers of growth here in the airline industry. Southwest as a domestic player with very little debt. Delta Airlines as the better of the three legacy carriers with the least amount of debt and the best positive outlook here. But when we also look at another player that kind of is at the intersection of both, has some domestic, has mostly domestic business, but also some international exposure, but also has relatively low debt, just like Southwest Airlines. Alaska Airlines also is a potential airline to pay attention to. And Alaska Airline is at both a potential breakout here in the short run and also potential breakout here in the long run. Short run here around that $72 level, double top breakout here. On the long run, $74, $75 all-time high here. Potential breakout here, a much bigger breakout here to the upside on the weekly chart here. So this is one that I'm starting to pay attention to, especially as we see airline travel pick up. We're only about 150,000 passengers per day from a TSA perspective back into what we would consider a fairly normal range prior to the pandemic. So we're pretty close to getting there in terms of our peaks, just to the lows that we normally would expect here prior to the pandemic. So things are continuing to shift here to the upside. And especially when you have that nice blend between domestic and international with a low amount of debt, that's really where I think Alaska Airlines is another interesting airline to pay attention to here. Now, on the reopening side, Disney is interesting because, while Disney hasn't made a whole lot of progress here since December, the stock was at 180 or so at the beginning of December. It's now at 188 a few months later, and I would argue that the markets the risk here for Disney and the outlook for Disney looks substantially better than it did back here in mid-December or early December. So the fact that the stock's trading near the same price, we have more data that Disney Plus is doing fairly well in terms of streaming. We have a fairly strong outlook here for the second half of Disney parks reopening here, especially with US vaccines continue to grow at a very fast pace here, certainly outpacing the rest of the world. The UK and the US are greatly outpacing the rest of the world here. So the potential upside here for Disney, I think, is fairly strong. Short term, looking for that all-time high to 200, long-term breakout above that $200 level to continue moving higher here, looking at Disney. And lastly, looking at the semis, looking at technology. Where do you look for opportunities within technology? And that's really where semiconductors, in my opinion, still look fairly strong here over the next few years. And when we look within semis, the NXPI really continues to screen at the top of our list for multiple reasons. They operate in two particular spaces that we think are going to continue to see strong demand here: security and automotive. They are a leader in terms of automotive. There are a few competitors in terms of security, but they are a leading player in that particular space. But on the automotive side, pretty much all automotive chips, whether we're talking about just the ones that control your radio to GPS to ones that are higher performance that drive autonomous driving, NXPI is the leader in that particular space. So it continues to scan well from a semiconductor space. The only warning that I have about NXPI is this negative divergence that we're seeing. Higher highs, but momentum no longer confirming those higher highs. So my preference is to wait for pullbacks here into that 21-day moving average before looking for long opportunities. But this is one that we continue to have on our watch list. Breaking out to new all-time highs here above 210, worth putting on your watch list, as most semiconductor stocks are not trading near all-time highs. NXPI is an exception to that and continues to scan well, especially after its inclusion into the S&P 500. So with that covers what I wanted to share with you here today, how I'm looking at the broader markets in terms of where we see opportunities, whether or not we see a continuation here of the broader markets higher, and what sectors we want to pay attention to here in the broader markets. So with that, I want to thank our members for taking the time out and allowing us to do this every single week. And I hope that for those of you that are currently on a free trial or just testing us out, will consider supporting us here and becoming a member for just $75 a month or $500 a year to allow us to continue doing this. You can sign up using the link that I just posted here into the chat window. And if you're brand new to OptionsPlay, if you're just starting out and you want to get access to some of our signals, our education, our research, the information that we put out every single day, you can sign up for a free trial at OptionsPlay.com. It's a full 30-day free trial. You get access to everything, test it out before you have to commit to a membership. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here on the next session here, which is on Thursday. We're going to talk about buying calls and puts, basic strategies, making sure you understand those basics before we evolve and discuss some more advanced strategies here for the month. So with that, thank you so much. Have a great trading day, and I'll see you guys here on Thursday.